Hello, everyone, and welcome back to the Daily Gold YouTube channel. Thank you so much for tuning in. This is Monday, December 30th, 2024. We're coming up on the end of 2024. And with me today for Macro Mondays on the Daily Gold podcast, one of my favorite guests. He is Gary Tanashian, the editor and publisher of a great newsletter, Notes from the Rabbit Hole. And Gary, unlike most gold and silver fans and bugs out there, he truly understands what the root drivers are for the sector. And Gary, that's one of amongst many reasons why I appreciate your work and appreciate you coming on. First things first, I know in your recent updates you've been talking about how the fundamentals for gold have been improving, they have been getting better. Let me play devil's advocate. We see the stock market's making new highs. We see the dollar is strengthening. Long-term interest rates or bond yields are also moving up. Precious metals, technically, they're correcting. So in a shorter term sense, they're weak. Looking at these things, it doesn't sound to me like the fundamentals for gold are improving. But I give you the floor to debunk that.
Well, America is great again. So you're right. Interview over. Everything's fine. Um, and that's what I think we're in the midst of is the year end happy surge in cyclical markets after the election result. The knee jerk was up right after Trump was elected, and then that got corrected. But in general, the precious metals have been kicked off into a pretty hard correction. I think it's in essence an ABC bull market correction. And, so we're in that shorter term phase within, I think, I don't think, I know, a longer creeping, grinding improvement in the fundamentals for gold and especially gold stocks, which will leverage gold and its standing versus other markets, cyclical markets. So we're on track, but it's a correction right now that is normal and very much needed, actually, if the sector is going to get cleaned out and ready for the next rally. And we need to see all that happy stuff start to spring some leaks and to be recognized by a wider majority, or not necessarily majority, but section of the investing public needs to become concerned about the risk on cyclical stock market and other associated asset markets. So we are in that process, and it is a process. And right now we're in a gold stock and especially silver correction. And when that runs its course, I would like to see that have led cyclical markets into a downturn. I mean, if you look at, there's nothing more cyclical than copper and copper stocks, and that thing's getting beat on as well. So, one by one, I think pegs are getting knocked out from under this market. And, we're in silly season into the end of the year, perhaps part of January. And then the big, what I see as a potential contrarian play when America is officially great again. And regardless of who you voted for, who you do or don't support, I'm using that not to make fun of the situation, although, that could easily be in play as well. But it's a majority of people think that the businessman is going to fix the economy and deregulate, cut taxes, but he's going to use debt to promote all that. And I also don't think any policies kicked into gear in the first half of 2025 are going to halt or arrest what is already in play, which is, in my keeping it on a political viewpoint, the Biden administration, which propped the market in several ways, which I won't go into, but we tracked it all year long, in NFTRH. They're taking their ball and going home. It's a lame duck presidency, and the new guy hasn't been sworn in yet. And that swearing in could be, if the market has one more upside to it, one more flash of glory or whatever, that could be a great contrarian signal right there, if it hasn't already topped.
Yes, Gary, let's talk about the various indicators that you watch. I know the yield curve is one, the gold silver ratio. Uh, if there, I mean, perhaps weakness in semiconductor stocks relative to the market. Um, as we go into 2025 here, maybe you could just go through, if you'd like, two or three of your favorite indicators that you're watching that will at least tell you that the market is really ripe to roll over, and at the same time, precious metals fundamentals, gold specifically, are improving.
Well, you just named two of them, gold silver ratio and yield curve. And with the gold silver ratio, which is now each day it's hinting more bullish, which is bearish for the precious metals when gold is rising versus silver and they're both declining. Obviously, it's bearish. But that would also cast out and has cast out to many commodity segments. And eventually it should hit the stock market as well. When the gold silver ratio is rising, and not gently, but more impulsively or obviously, and the US dollar is attending and receiving that, maybe not a liquidity bid yet, but I think it's receiving smarter money, slipping out the back door of the asset markets. So, in Bob Hoy's astute words, gold versus silver is a metallic credit spread, where the less inflation sensitive, less cyclical metal within the precious metals rises versus the one with less of those, or more of those characteristics, I should say. So it's just not a positive economic signal. And given that silver often leads the rallies in the precious metals, it's not a positive signal in the precious metals yet either. So yeah, the gold silver ratio and US dollar combo right now, they're constructive to bullish and quite bullish, respectively. Doesn't mean they're going to stay that way. And I'm indeed on watch for a reversal, because again, it's silly season. We're finishing up a year with a lot of inputs to it that are about to change. So for all we know, we could go inflationary sooner rather than later, which would probably see silver take over and the gold silver ratio drop and lead the commodities, and maybe some stabilization in the stock market if it ever decides to take a real correction, which is, right now it's just deciding what to do, to further the pullback or to hold here. And then the yield curve is steepening. And, I've written a lot of content in NFTRH and also publicly proving that a steepening yield curve has come with bear markets and recessions. It's a matter of timing after the inversion and into the steepening, but we're well into a steepening now, and the yield curve has also dragged, or the 10-year, 2-year yield curve is now dragging the 10-year, 3-month yield curve upward as well. And it's a resounding negative cyclical signal. So unless they've changed the rules of the last 2 bear markets and the last several recessions, this thing will have bearing on the markets before long.
I guess a follow-up to that, um, is there a signal that could tell us that the market is ready to roll over, or at the same time, could that signal tell us that the market could have one last, thrust or push to the upside, given the the perceived optimism with, the Republican business guy president coming in and all that you talked about.
Right.
What's the indicator that could tell us that we're going for a blow off versus it's just going to roll over?
I really can't name any single thing, Jordan. I'd be watching the VIX, which is kind of it gets testy up and down. It's fairly sensitive. I'd be watching both the dollar and the gold silver ratio. Um, yeah, but it comes right down to daily chart technicals to me, and they haven't broken down. So I'm not abandoning the upside blow off scenario, excuse me, for that reason that it's still an uptrend, purely uptrend. This degrading signals and leadership and all that. But in last week's market report, we also noted that that the semiconductor index has not completely broken down. In fact, it has recovered its moving averages, and if that thing decides to start leading again, that would be, it's the market leadership chain in the U.S. that I follow, which is the SOX, the big tech, NDX, and SPX, the broad market. And so I think we'd watch something like that to see if the cyclical leader retakes control, as it is. Tech had been leading or took over leadership recently from the S&P 500. So we'd watch probably those market internals as well as our other indicators, the negative indicators, if they back off a little bit, possibly a recovery in treasury bonds. How's that for a little Goldilocks feel good kind of thing if suddenly inflation fears tamp back down here and yields, treasury yields start to drop, So there's probably a wide, large group of indications that we'd have to marry together to say, or one day it just shoots up and impulsively takes out the previous highs, and you're on a last chance power drive, or if I'm wrong, a new bull market extension. But I say last chance power drive because I'm expecting a market top in the next several weeks, if not, few months. But that's top
Hmm.
call. We both know how that goes.
No, yeah. But yeah, well, the more calls you make, then the more likely you're to be to get one right, and then you can just promote that like you have 1,000% batting average.
Right.
So, yeah, so let's talk about bonds and bond yields. So, are you thinking when we do have the next recession and downturn that like it could, maybe it'll be a little inflationary at first, but then you get bonds kind of rolling over and the yield curve really steepening? I mean, is that kind of the scenario that you see? Because I don't mean to trail off here and add in my own 2 cents, but it seems to me, I mean, we know that long-term inflation is a major problem. Like that's going to be a major problem. But short term, it just seems that everybody's convinced, inflation, the Fed can't cut. Gary, only one rate cut is priced in over the next 13 months. So to me, that looks like it could be a contrarian situation where if the economy weakens, if something happens, and suddenly the sentiment is the economy is getting much weaker, if the Fed has to cut aggressively, I mean, it seems like you could have a huge rally in bonds, even in the context of what you have pointed out so adeptly over recent quarters. Is they've broken out uh, past the what is it, the 100-month exponential moving average. So I don't know if there's a question, and I guess the question is, I guess talking about bonds and the contrarian opportunity, and I guess what that signal could mean for the broader markets.
Yeah, that's Goldilocks right there. But we've been expecting Goldilocks to morph into what you were just explaining, where we start realizing the economy's going in the shitter here, and bond yields drop and bonds rally, I would say, especially given the nice, healthy correction we're getting now, gold would come next. Or put it this way, I'd be expecting bonds to rally. I hold my short-term treasuries and then really getting revved up about gold when you're not supposed to be. Or I should say when you are supposed to be, but to a majority, you're supposed to be puking gold right now, when really that situation you just described, where bond yields fail, bonds take a rally, economic weakness starts to pervade, and that's implying future pressure on the Fed to go dovish again, and there's your case for gold. Countercyclical, not for inflation, or certainly not primarily for inflation, but for when things fall apart. And yeah, so I think the bond yield play right now, it's another part of silly season. I have on that big picture 30-year treasury yield chart. We do show that a bull flag has broken to the upside on yields, but that could be all part of kind of a fake out or a whipsaw here. Economic signals are definitely pressuring bonds to be a flight to safety instrument, pressuring money into short-term treasuries. But where was I? Lost my train of thought on that.
Yeah, talking about how the economy rolling over and how money could go back into bonds. Is that what you were leading up
Yeah, I
to?
mean, that's where the money will go, into short-term bonds.
Because what one, I just to stop you for a second. It's interesting because now we have the dollar is rising, bonds are selling off, but that money is going into the stock market as a flight to sit. So yeah, this is another question. Money is going into the stock market. The Mag 7 as a flight to safety right now
Right.
because
Yeah.
bonds are selling off. Because I've noticed in the past I mean, previously in the last 3 years, when we had bond yields going up and getting at this level, it hit stocks, but it's not hitting stocks anymore because the money that's exiting bonds is going into stocks for safety. So I guess to me that's an interesting thought is okay, well when does that mean bond yields will have to top first and then roll over before stocks?
Well, how about this, Jordan? How about if it's really just dumb money finally chasing the stock market in an end stage situation?
Yeah,
They don't, I
could be
don't think
that
dumb
too.
money is really going to be saying, well, bond yields are rising and, that's economically, whatever they might think. It's actually, it can run with a strong economy, but, we're going into more debt. They're projecting the Trump administration to get right back at the debt increase, to fund tariffs or to fund, I'm sorry, tax cuts, and tariffs will be a separate inflationary pressure, uh, according to those who study the history of tariffs. Um, but I think the stock market might be just in its own bubble, so to speak, literally and figuratively, where you've got insiders selling at very historically significant rates, and you've got dumb money entering and momentum having hit the markets. It could be as classic as the wrong money is sponsoring stocks at the wrong time, and could be just a classic ending signal. Of course, it could end with a surge upward, which is what I want to be careful of. I've got a few short positions and not many long positions. And excuse me, I want to be just watching all of that, because we're in a funny window where I think emotion, especially post-election, emotion is at a high. And I'm not sure logic is at a high right now. And I'm not sure the average market participant is watching signals and quanting history and saying, well, the last time we had these three signals in play together, or the last two times, if we're looking at gold silver ratio and the yield curves, and there are several other things we could throw in there. It's just it's not the right time. And I don't care how long it takes. I'm going to call it what it is, which is a very at-risk market. And I've done that for a good part of 2024 while only being long and in cash, which is still paying a good return. So, the short term is in a bit of a flux here with the low volume holidays, with the emotional aftermath of the election. But, we have one administration folding up its tent and going home, and another one incoming, and a lot of questions about all that. I think the bond market has been saying he's going to, implement tariffs, and he's going to raise the debt because he's promising tax cuts. And those are probably all going to happen. And that drove yields up. The only thing that's going to pull them back down is continued softening into like outright concern about the economy, which I don't see reversing. But again, I don't control the macro. So we'll see what actually plays out. But it will pay to follow history and historic trends and outcomes that have happened when we've had these elements in play.
Okay, Gary. Let's get back to precious metals. Let's talk about gold and gold stocks. Well, first thing about gold stocks, something I've been noticing. If you look at a lot of these indices, I know you look at the Huey more than GDX, but GDX, XAU, even the XGD, which is the Canadian GDX. I mean, these things have some really, really bullish bases. And I don't know if you saw, but there's a chart. I absolutely love this where it shows the percentage of or percentage of assets in all the gold stock ETFs divided by just assets in all stock ETFs. And this thing is at a 17-year low. Like, I'm not shitting you. This thing is at a 17-year low. And that's pretty amazing because we have this bullish setup technically, and we have this sentiment indicator, based on actual money flows into ETFs. It just seems like, to me, again, I don't want to ask a leading question, but if we get the macro aligned for gold and gold stocks, that's that's setting up like a beautiful contrarian super bullish situation.
There is. And the fact that the sector is declining now is even better for the setup. Even regardless of what the fundamentals are doing, and they haven't fully kicked in yet, we need that stock market, the headline index that everybody watches, the S&P 500, that thing needs to crack. And the Mag 7 you mentioned, those hiding places need to be ferreted out. And but on the trends, the fundamentals for gold, and by leveraging that, gold stocks are heading upward, and it would just be super to be able to have a buying opportunity on the downside with the view you just expressed in your pocket. I like to buy for more than just technical, like, oh, I think it's going to point C on the ABC correction. It's there, I'm buying. I want to know what's happening around the sector fundamentally as well. And I see what you see, the first part of the rally from March, I think it was early March to whenever we had the last top. It was in unison. It was a leader of the broad rally. So now we're on correction, and it's conceivable that we top out in the broad stock markets, and real concern starts to hit people, and they look for alternatives. And they'll find those in very short-term treasury bonds for liquid safety, and they'll find it in gold. And then when they realize gold is outperforming so many other markets, they'll find it in the gold miners, which leverage that outperformance. So I don't want to say excited. It's not a word I like to use in the markets, but I am looking forward to and expecting a solid buying opportunity into the bombed out situation, sentiment wise, that you just elaborated. But sentiment did get too brisk in the short term. So we're correcting a short term over bullish situation now within the concept of a sector that is kind of like chronically ignored and really not on anybody's radar. Gold stocks suck now, always have sucked, and why would I ever buy a gold stock? That's sometimes my view, but more often it's the majority's view. It's not even on anybody's radar when you can buy Bitcoin or something sexy like that, Nvidia. Who wants to buy a dirty gold stock anyway? Well, I do. At the right time.
Beautiful. Well, yeah, I apologize if you've already answered this or if this is a redundant question. But okay, so fundamentals for gold and gold stocks, they're improving. When would you say is the point where the fundamentals are at their best to really launch a market move? I know that that doesn't necessarily mark like a bottom in the correction or the decline, but I guess what I'm trying to get at is when do you think the fundamentals are just really at their that they're so good you just have to buy, regardless of if the market's coming
Right.
down, it's getting really oversold. Like when is the point and what is happening with those indicators where that's telling us the fundamentals are act like this is really the best point. Like they've turned the corner, they're about to get really strong.
Well, my main fundamental, there are plenty of non-gold and gold stock related fundamentals to consider that are still have bearing on the sector. But the primary one that is going to work better than anything is when gold bottoms, turns up, and starts to change trends versus the S&P 500. It's already trending up versus lesser indexes and sectors and markets. So that's good. It's trending up versus many commodities. That's good. But I think when it makes its first impulsive move upward or its next impulsive move upward in relation to those markets, which probably means they are rolling over. I mean, again, gold, copper is in a nice steady uptrend, gold commodities, gold oil, all of that. But I think it needs to take down the S&P 500. I really do. So many, you mentioned the Mag 7, and also I picture machines just programmed to hide in the largest cap stocks and ride it out. We need to hunt that down and expose that. We being, the market gods, I guess, need to address that and bring reality, a good dose of reality, I think, to the investing public. But that will be seen when gold starts to like spike upward, I think, in relation to stock markets and even some other items that it has already been outperforming, like commodities. And it needs to change the trends eventually. We're in a long base, so using gold SPX ratio, it's just a long trough, and it's a bottom, it's a base, and when gold breaks upward and takes out, like let's just say, creates support at the top of such a base, tests that support. It could be a process, could happen overnight, who knows? But I want to see gold outperforming cyclical markets. And I want to see it doing it in a belligerent, consistent way. 2024 has been up and down and indicators flashing and then going into hibernation, then coming back. It's been very skittish and volatile in indicator land this year. But we want to see gold gaining that bid that short-term treasury bonds should gain as well, that liquidity, safety, safe haven bid. And I don't want to hear about politics or war or any of that. I just want to see economically, I want to see the average participant forced to like take refuge. And that's when we'll be on the next phase, I think. And the longer term bull market for gold stocks, which comes out of a disinflationary, deflationary, contractionary macro environment, as opposed to inflation, which is too often touted as the reason to buy gold stocks. So we're looking for the opposite of that, basically, into the next inflation, perhaps, where there's a whole process. First, you need mass recognition of a recession. Then you need the Fed to get off its ass and go dovish like we know it will one day. And then the next inflation will come from that if previous episodes are prologue to the future. But the gold stocks should be way along by then and into a future selling opportunity or whatever. But I think something bigger and longer lasting could be in the offing in 2025 after we find a low here. And again, depending on the cyclical risk on markets doing, as I think the indicators are saying they will eventually. So we have to be patient and keep perspective on things. But it's coming, and I'm not just some, gold stock cheerleader, rah-rahing the troops. And, it's coming, but just believe me, stick with me. I'm short silver right now, and hardly long anything in gold stocks, just partial positions of my core. But it's, coming for valid reasons. There's a calculus in play here where, I've added this, subtracted that, seen that, factored the other thing, put it all together. And it's a long, slow process towards something that, as you implied, will catch a lot of people by surprise because they're not paying attention and have not been for many, many years. So it's exciting in a long, slow, boring way.
Yes. Yeah, I guess I have two questions for you, Gary. But first one, before I let you go, please tell us where we can go to find all your work and subscribe on Twitter/X, and also how we can subscribe to your premium updates.
Well, I'd love to have folks come and check out the website. I have recently decided to reinvigorate myself with public posting. For internal reasons, I'm bringing on a little help, and I've got more time. And the website is NFTRH, Notes from the Rabbit Hole, NFTRH.com. And Twitter is, what is it? NFTRHGT.
Yeah, I think that's
X
it.
or whatever. But there's more public posting going on. I had really slacked off. It's been an eventful year for us outside the markets anyway, with a move and all that. It just pulled me away for extended periods other than the premium service. So I am committing to more public posting. And then should you find the information that's available publicly helpful, then consider that the premium content is that times 10 and on it every single week in weekly reports and NFTRH plus updates, because there's a real market nerd running the thing and he wants to be on this. And my goal right now is to try to be available when the market's top, because I've tended to miss the previous market crashes and just have to settle for being in cash. But I think there's going to be room for speculation from the short side as well. So it's an ongoing thing. Aside from just the gold sector, it's there's a whole ball of wax out there, and I think a lot of change is coming. And we'll be on top of it at the website. That's my long answer.
Great, thank you, Gary. And I understand sometimes when you come out of the rabbit hole, you do play some music. I see the guitar there in the background. Uh, maybe you could pitch. I know I think you have a gig coming up. In case any listeners are in the area, would love to hear your they like your macro analysis, and they say, hey, maybe this guy's a good musician as well. I'll give it a shot.
Give it a shot, and he sucks. But you can hear people can hear the music I write at the website under the About tab. I link to it, and that's just my personal stuff that I write songs. Some I really like, others I would rather people don't listen to. But and also the disclaimer is I'm not a vocalist. I know that. But when I sit at my desk and I create songs, somebody's going to do the singing, so I do it. But the band thing is really new. We don't even have a set list yet or anything. We're just, in fact, I'm meeting the bass player for the first time today, and we're just going to jam out some stuff and maybe in the spring play a gig.
Well,
And
outstanding. Yeah, that's very exciting. Well, on that note, Gary, thank you so much for coming on. Love your analysis. We'll point people to your website and your premium service. And this was great, Gary. I hope we can come back. I hope you can return in the next couple months when we're at that topping point or maybe past it or just whenever and get an update on how things are progressing.
absolutely. Thank you very much, Jordan. I appreciate it as always. Have a happy new year to you and the folks out there.